Hey there, welcome aboard. It's Walter here, and we're going to talk about trade level compounding. Reason why is it seems like this has been a popular topic. We've been doing videos on this recently, and I notice a lot of people have been commenting.
Trade level compounding.
So that's what we're going to talk about today. Now, what I want to do is share with you what this looks like, because it's once you understand the math behind it, you'll see exactly why what we're talking about here is not reverse martingale. You don't see the exact same effect on losing streaks or drawdowns as you do on equity peaks or winning streaks. You don't have to anticipate any sort of winning streaks or anything like that. In fact, you don't even incorporate those as you don't expect them, because they will occur by chance. So that's really what it's all about. It's about rolling the dice and letting it roll. So like the important thing to note here is, even with the important thing that you want to do with your trading system is have a high reward risk ratio. Win rate is secondary. Now, win rate doesn't affect the percentage of winning streaks that you have. And you do need to have, at least at the very minimum, 2 winning trades together to make this work. It doesn't really matter if you're trading multiple strategies. That's not critical. Hey, Sachin, great to see you here. So it doesn't really matter. That doesn't matter. What matters is that you understand the math behind it. So let me show you. I'm going to jump in and show you on my screen what the math looks like. Okay, so let's have a look. The math is here. Right here. Okay, so what we're looking at right here is a handy dandy, fancy schmancy table that shows you the outcomes. So what I have here on the one, so this is going to be a 3-to-1 reward risk ratio. Okay, fair enough. Now what we have here on the one side is we have our normal sort of trading system, or normal sort of reward to risk ratio, normal event. So normal compounding at the account level. So in this case right here, this is normal. All these are normal, and then these right here are trade level compounds. So what happens is, on this 3-to-1 reward risk ratio strategy, if you have a case of a loss followed by a win, what happens? Well, you're going to lose 1. You're going to lose 1R, you're going to gain 3R, and you're going to end up 2R. It's the same with trade level compounding. You get the same result. Now, when you look at the next one, when you have a loss followed by a loss, what you're going to have here is 2 losses in a row. So obviously you have 2R losses. Hey, we have a visitor. Hello, how are you? Would you like to? Oh, yes, we have an important poo emergency, so I'll be right back. I'll see you guys in a minute. We've got a poo emergency. All right, the poo emergency is taken care of, which is excellent. Now, back to trade level compounding. So what it looks like here is you have a loss and a loss. That's -2R. And a loss and a loss with trade level compounds, only when you have a winner that things change. So when we have a win followed by right, you can catch that if you want and risk only the winnings and not the additional R, but I like to risk the additional R. So that means you would be break even at that stage. Now, what happens if you win-win? Well, it's completely different. Win-win means that you're going to end up 3, 3, so you're up 6 normal trade level compounding, or sorry, account level compounding. That's normal, 2%, 1%, whatever. But here's what happens with trade level compounding. You win 3R on the first trade. The second trade payoff is 12R, and you're up 15R. So that's really the big difference here. It's the 9R that you make with the win-win sequence. Now, obviously, the chances of you having a winner after a winner is your win rate, okay? So if your win rate is 50%, then the chances of you having a winner after winner is 50%. If your win rate is 25%, the chances of you having a winner after a winner are 25%. So that's where it changes. Essentially, if you look at it this way, if you just look at these right here, what you're doing is you're trading the +2 and the +6 payoff for the -1 and the +15. That's essentially what you're doing. You're actually making 14R with trade level compounding, and you're making 8R if you just look at the other setup, the account level compounding. So you're only making 8R in that case, and that's basically how it works. So does that make sense? I'll show you what I can do here is show you a spreadsheet, because this is going to help you see this. I think this is probably going to be the best way to see this. I think this will really help. So let me show you what it looks like when you, first of all, let's look at this one. So this is trade. It's the best strategy I've ever used. Cool. Glad to hear it, Joaquin. So let me share with you this. So this is a 37% this is what it looks like. Let me make this bigger so it's easier to see. But basically, the first I don't know what this is, first 100 trades or whatever, the account's basically at $4,000. Okay, that's not trade level compounding. This is account level compounding. Okay, that's what that is. Account level compounding. That's normal. We always talked about this. That's normal stuff, right? Now we go over to trade level compounding, and it's completely different. And this is what you're going to see. This is actually, this look and feel of the chart of the equity curve is a lot of times this is what you're going to see when you're trading like a pyramiding strategy or something like that. It has the same kind of look where you get, it's the opposite of a martingale chart. Martingale chart looks like this and then falls off the cliff. What happens here is the market goes and then falls, and then it goes and then falls, and then goes, and you see it like this. After 100 trades, it's actually only up to like what, $1,400 or something, right? $1,500. So it's actually worse off. And this is the classic case of the turtle beats the rabbit, you know, the turtle beats the hare sort of thing. Because if you go down here, let me share with you the next sequence is the next 100 trades, like up to from trade 100 to trade 200. And right here, again, look what happens. So this is trade one, from trade one, the beginning at $1,000, the account gets up to whatever this is, you know, 5,500 or whatever it is. I don't know, 5,470. Now, if we compare that to our other normal, just risking 2% per trade or whatever, actually, it's not 2%. I'll tell you what it is. It's 3% per trade. So this is risking 3% per trade. You get a completely different equity curve. And instead, you're looking at, again, whoa, it looks a lot better, doesn't it? Right? It's not at $5,000. It's at 11,600 normal trading. So you would think that you're better off not trading this strategy, trade level compounding. However, like I said, it's a classic case of the rabbit beats the hare, right? No, the turtle beats the hare. Is that, yeah, turtle beats the hare. And so what I want to do now is just share with you the last, from like trade 200 to trade so it's going to be here from trade 200 to trade 330, which is going to be right here, 334, I think it should be, yeah, because there's 4 up there. Okay, so now what we do here is we put our little chart over here. And hang on, where's that bad boy? Where's that chart? Here it is. Here, and again, remember, this is risking 3% per trade. So it's quite aggressive. And you can see we're up to whatever it is, 120,500, right? 124,000, whatever. And then if we go over to our more aggressive, here's the more aggressive one right here. Look at where we're at. This is just from trade 200 to trade 100 and trade 330. From trade 200 to trade 3. I just cut it off there because I didn't want to. It gets ridiculous when you start to look at trade 2000 and stuff like that. But look what happens here. You're actually, now you win. So now this is where it starts to pull away here when you get to trade 300. That's why in the small accounts, big profits course, which you can click the link below or above this video if you want to get in on that. That's why I talk about trying to play the long game. When you start compounding at the trade level, you really want to do it over hundreds of trades. Because if you just do it over 20, 30, or 100 trades, you'll be like, this stinks. You trade 300 trades, you play it out 300 trades, 400 trades, 500 trades, that's when you start to pull away and you see the big difference between trade level compounding and account level compounding. So it's a very big difference. I just wanted to share this with you. Oh, by the way, these are the exact same trades, the exact same sequence of wins and losses. The only difference is in this second chart right here, this one right here, where it's at 144,000. That's when you're doing trade level compounding. And this one over here, where it's at 124,000. So we're up 20 grand now on trade level compounding. This is where it starts to peel away. That's the only difference, is that we're just risking 3% on every trade. So we're just account level compounding. So does that make sense? We don't use optimal F. Good question. We don't use optimal F. There are others. This is just one of many different strategies that we talk about in the small account big profits course. If you want to get in, you can click the link below this video or above the video, and that'll have more information about it. But it's what we're trying to do here is the goal is over 300 trades to maximize our account. So the goal is not to avoid drawdown. We understand drawdown's a part of the deal. So that's really important to note, right? We own up to the drawdowns, and a lot of that actually is psychological. The reason why drawdowns are so tricky for a lot of traders is because they don't account for them. They think of the payoffs. They think of, I'm going to make all this money and blah, blah, blah. They don't consider the fact that I'm going to have to go through a 30, 40, 60, 70% drawdown on the way. And that's where traders quit. They quit during the drawdowns, and then they never get to see the big payoffs. So if you're getting really aggressive, first of all, I like doing it with a small account rather than I don't want to lose a lot of money. It could go wrong. You could lose it all, or you could get into such a serious drawdown that's going to be really take a long time to get out of it. So this is the way that it works. It's not reverse martingale like some people are saying. Reverse martingale would be like every time you have a win, you keep adding to it. That's reverse martingale. So, because in martingale, every time you have a loser, you keep adding and you try and get that back. So that's not, it's not reverse martingale. I'm just talking about, in this case, there's different ways to do it. But in this case, we're just looking at trades in 2 trade blocks. If you look at trades in 2 trade blocks rather than individually, that's when things change. You can switch systems too. So if system A gives you a winner, you can take the winnings from that and apply it to system B. That's okay too. Because remember, the probability of us having another winner is simply the win rate of the strategy. If you're trading 5 systems, you can literally take, if trade system 1 provides a winner and the next signal is on system 7 or system 5 or whatever, you can take the winnings from system 1 and apply that to the trade on system 5. It's okay. There's no rules about keeping it in the system or whatever. Again, we're going to talk about all that in the Small Accounts Big Profits course. So I hope this helps. I wish you happy trading, and we'll see you in the next video. Take care. Bye.